Okay. Hiren Ved, hi, afternoon. The top three words used in the budget so far, as my team tells me, is development, invest, and infrastructure. They were all used some 33 times as opposed to the other word count. But what do you think, Hiren, is making the markets a little bit nervous? I mean, is it just typical volatility, or would you say that the net borrowing number being much higher than anticipated is what's making markets a little bit nervous?
So, I think if you want to judge the budget more than equity markets, it's usually the bond market and the currency markets which will tell you what the budget is all about, right? So I think I think all three markets are behaving in the way they perceive the budget. I think for equities, it's a positive budget because it's a clearly growth-oriented budget. Yes, I do agree with Mr. Dangi, who was on your show, that it would mean higher interest rates, perhaps a slightly weak currency. But I think that if you had to take a choice and if you have to take a call at this stage, my view is that the call should be to go for growth, right? Because in India, what I've seen is that growth solves a lot of problems. And I think if you look at the budget math, and I was looking at after the speech, I think the numbers are very, very credible, just like they were last year. I think they've taken nominal GDP growth at only 13%. Most of the revenue, the total revenue tax receipts are only 10% higher, which means that there is a reasonably good chance that you will again beat those numbers when it comes to tax revenues. Yes, the borrowing program is big and significantly large, but you can't have it always. So you have to decide, you have to take a stand. And I think the government has taken a stand that we want to go for growth. And it is okay to have a slightly higher fiscal deficit. And so the question you got to ask is that if you want to take the risk, do you have the ammunition to take that risk? And my answer is yes. I think we couldn't have taken that risk in FY13 or 14 when the taper tantrum happened. But I think our balance sheet and our macro is reasonably strong enough for the government to stick its neck out and take the risk of spending higher. So I'm all for it. I think I like the emphasis on the budget. It's uncluttered. It's very clear. And it says that we're going to go for growth. And hopefully, this growth will start a virtuous cycle of higher spending, higher private investment, higher employment, higher revenues for the government. And that's how you should consolidate your fiscal rather than trying to rein in fiscal deficit when growth is most required. So I would say, thumbs up. And I think, as far as equity markets are concerned, frankly, tomorrow everybody will forget what the budget is all about. But for whatever it is worth today, all I can say is that there's nothing in the budget that would make equity markets nervous or jittery.
Hiren, but while the budget is pro-growth, it is also indicating that risk should be taken. Could this also come at the cost of stoking inflation?
So I think, inflation has many legs, Nikunj. I think a lot of the inflation was also because of supply chain issues. You were shutting down and opening up the economy. You keep doing those things. I think once we are out of capacity constraints and the supply chain is reasonably sorted, my sense is that a little bit of inflation, there is no doubt that this budget is going to be inflationary as the numbers stand today. But inflation has always been good for corporate profits, and one of the reasons why you saw a strong beat, if I were to use corporate language, in terms of revenues between what the government had budgeted and what they came up with, I think a large part of it was also thanks to inflation. So I'm not too worried, unless obviously you have a runaway inflation, then you'll have a problem at your hands. But I think that, I think I'm fine with a slightly more expansionary budget, slightly more higher fiscal deficit, and go for growth.
Hiren, so does the bent of the market decisively change now? Because if you know that expenditure is going to be focused towards infra, it will help industrials, cyclicals, corporate banks. The bent of the market, do you think decisively changes?
So I think, I think that change was already underway, where, I think the more reasonable side of the market in terms of valuations had started to do well. And yes, I think, if genuinely we end up executing on a 7.5 lakh crore capex program, then I think that'll be very good for metals, cement, capital goods, infrastructure companies. Now, whether you should go ahead and buy those stocks, I think that's a very independent view that you need to take. But from a macro perspective, yes, I think that there is a shift that is taking place towards allocation to sectors which really struggled thus far. With one exception, I still believe that exporters and technology, which is a large part of the Nifty, and free cash flow positive companies, I think they should be a good hedge in your portfolio if genuinely everybody believes that inflation is going to go up, the currency is going to depreciate, then I think you should maintain your exposure to technology companies, to IT service companies, because that will be a good hedge. And it's not just a defensive play anymore. These are now growth companies. We are in a multi-year technology spending cycle. So I think that definitely the shift is underway to more cyclical sectors, to more economy-oriented sectors. But you also need to have a healthy mix of exporters in your portfolio.
Side, Hiren, spending in infra ultimately will have impact on rural demand and consumption. In this inflationary environment, an HUL has gained market share, a Titan has gained market share. What are the chances that the rural economy, which has been subdued, that also comes back? It is a multiplier which will get impacted. So rather than only focusing on industrials, go to good old consumer dominated names.
So, Nikunj, I think if you look at the consumer names thus far, you're absolutely right. I think the trend of consolidation in market share amongst the more organized players is something that has been playing out ever since GST has been implemented. And then COVID further accelerated the consolidation. So I think that theme of consolidation will continue. What you don't want in consumer companies or FMCG companies is runaway food inflation, right? Because that's their raw material. I think, because if you're talking about rural demand, that's a very price sensitive end of the market. And, it becomes very difficult to pass on very aggressive price increases, which may impact volumes and demand. So I think that as long as we don't have very high food inflation or raw material inflation, I think rural income will come back if infrastructure and the construction industry continue to, really get a leg up from this massive spending program. Then hopefully this will trickle down to rural demand. The one interesting figure that I saw in the budget was that the allocation for Narega has actually been cut. Though last year there was a bump up because there was a special need during lockdowns because a lot of people lost jobs. But the bet that the budget is taking is that now growth will come back, and that would mean more jobs. Massive spending on infrastructure, on roads, on rural infrastructure would mean that construction would revive, and hopefully you would not need to need more money on Narega. So I think it's a bet. Let's see. I think rural incomes can come back, provided there is not a very big spike in inflation and raw material increases, because that might hurt volume growth. though you may get price growth.
Okay, Hiren Ved,